Now, before we get into the segment, we'd like to remind you, please like, share, subscribe. Your support is appreciated as always. Now, shifting a bit, and before we get into the U.S., because this is obviously covers the U.S. as well, we want to look at what is the employment rate of young people around the world, and this is 15 to 24, employment rate of people aged 15 to 24. Now, you can see the initial decline came at that 2008, the financial crisis, and it never really recovered. And that's, you see the drop, and then you went sideways with, UK getting closer, US, finally getting back to those levels. Only took about 16 years, but I should say, 12 years. But then you had this drop, and now the problem is, where do we go from here? Do we get back to where we were? Is it just this now flat line as there's a struggle to find jobs, or do companies want to get cheaper labor? And who's cheaper than a 23-year-old versus a 43-year-old or a 33-year-old? And that's where we're going to start to look to see, is this going to be a changing pace? But in most places, it was yet to reach pre-recession levels before the COVID-19 pandemic, which is why we keep talking about the issues that were in the system prior to COVID. And now with the statements from the Fed, now that they've officially come out, there was a number of changes to the Fed statement. So indicators of economic activity and employment have strengthened. The sectors most adversely affected by the pandemic have shown improvement. The problem is, all of this stimulus, we're now above pre-pandemic GDP growth projections. So how much more support can possibly be required in this market? Inflation has risen, largely reflecting transitory factors. Again, with his commentary of transitory, you have to define transitory. Is transitory in your eyes 6 months, 12 months, 24 months? Because when we look at grains, when we look at raw materials, when we look at supply chain disruptions, transitory is going to be relative as to what does that mean. The ongoing public health crisis continues to weigh on the economy. And right now, Powell said that the economy is at an inflection point. The economic data tells you that we are not at an inflection point. We're well past an inflection point, that we're booming. But then when you look at other indicators, you're like, okay, well, I get what he's saying, that there's some softness in this. But that's where we try to get more intelligent about it. Let's look at what's the good, what's the bad, and what's going to weigh out over time. But so far, we will continue to see Jay Powell do his thing and sending the printer go burr, which is, I think, everybody's favorite statement in terms of where this goes from here. And obviously, now that he's come out, the market moves right back to all-time highs, because obviously none of the good things or him being dovish isn't priced in, because I don't know. Apparently it isn't. But when we look at record deficit, this is what we continue to see, where as the consumer has come back in different ways and the market struggles to refill the coffers, here's where you can see just the trade gap on consumer imports. So imports of consumer goods are going back to 2008 at an all-time high, and the deficit widens to essentially the widest deficit we have ever had. And this is going to continue to get worse, especially as people get more money in their pockets, or as in the movement of stimulus continues to go through the system. We're going to keep buying from offshore, and the problem is import prices are only going up. There's a raw material issue, there is a supply chain issue, there is a shipping issue. These are the components that are going to continue to be a problem. There's a manufacturing problem. There are strikes. There are limitations. All of this. There's COVID rising in India, impacting supply chains further. All of these components are pushing prices up. So when we talk about inflation as transitory or transitory factors, what is how? And if you were to ask him, he would say 6 months. Because he is okay averaging above 2%, which could be 2.53%, which is the metrics they use. But we all know that they definitely without a doubt, undercount. So when we talk about consumer confidence, so mentions the Conference Board's labor market differential a few times today. While it remains a good leading indicator for unemployment, its recent track record on wage growth is far less impressive. A flat Phillips curve is a huge risk to the reflation narrative. And that's what we continue to see. We continue to see a problem with you're getting some confidence, so the consumer is more confident. We'll talk about that more later. But where is the wage growth going to come to? Because we're seeing some wage growth. I'm not saying we aren't seeing wage growth. The problem is that is going to be a big cost for companies, and how much of that can be passed on to the consumer before you start to see some residual pushback. And when you look at just the consumer confidence, especially on income expectations, greatly outpaced where actual wage growth went. And that's why we talk about this specifically, because the shift happened in really 2010 into 2011 when you saw all central banks just start printing blindly, and you expected this movement, you expected more to come, but you never really got that big wage increase that you were expecting. You never got maybe that 10% bonus. You were getting 1.5%, 2% bonuses, salary increases just to match inflation. But you never really got this, hey, you did a great job. Here's the money, or the company crushed it. Here's your share of the pie. You're just seeing that where the expectations were always there, but it never actually came to pass. And that's why when we look at jobs plentiful, the answer is yes. We know they are, but with the jobs being plentiful, we're still not seeing that wage growth, just like what we had from 2016 up into 2020 before the crash. The wages never really got there, and that's the stagnant, because now you have people that will never get back to that job that they had after being furloughed, and that's going to be that residual issue on wage growth. And this is just looking at job openings. So job openings in leisure and hospitality, not surprising. We should get a very good jobs number again this month. This month and really into May, because there's just more hiring coming on, but that's going to tail off. And the question is, when does it tail off and to what extent? And even though we've had this nice bounce off the bottom in terms of just job openings, the 3-month average of wages has just been flat. And you can see it's been flat going back to essentially 2016. This is where we continue to see this. The price of stuff continues to go up, and it has continued to go up through that time period, but you're not seeing it reflected in wages, which is just impeding even more consumer purchasing, which is going to become a bigger problem. Now, could you get a huge catch up? Sure, that is very much possible. And here's an example. When you look at Yum Brands, monthly visits, month over month, you can see that there's a huge jump in March. Does that mean that you're going to have to pay people more? And the short answer is yes. Right now, they're seeing an increase in hourly wages and sign-on bonuses just to get people to come back to work. And it's a mixture of you're making more money collecting unemployment, or maybe you don't have the skills for the job. And not to say that you going to Pizza Hut, you wouldn't have the skills, but looking further out, maybe there is that disconnect between the job skills required and the job skills that you currently have. And that's going to also result in just less spending, because the company's going to say, you're going to be less efficient, so I'm not going to pay you a lot at the beginning. But as we've seen in previous charts, they never make up. If you don't come in at the right rate, you're never going to get to what your potential is, and because you're never going to say, hey, you're now great, you're doing a good job, you're now back to where you should be, here's a 10% salary increase. That just doesn't happen, or happens less and less, or less frequently, which is becoming a bigger problem. Even though we do have job postings continuing to go up, the job postings are accelerating. We're now at 22.4% seasonally adjusted against February 1st of 2020. This comes down to that disconnect. It's less money. What is the money side of it, and what are the skills wanted? And when you on a corporate side, if you're looking at the job market and saying there is a lot of jobs out there, are a lot of people out there, I'm going to be picky. And that is very well the case, but we're seeing that it's still taking a long time to find the right fit. Now, I love this chart because whenever people talk about how CPI isn't there, well, let's just look at the mentions of inflation. So mentions of inflation on calls more than tripled so far, pointing to higher inflation. Now, this is looking at S&P 500 companies' mentions of inflation on earnings calls. When you're a company, how do you set your price? You set your price based on your cost and then the target margin. That margin can fluctuate based on what the market can handle, what your competition is doing, if somebody's trying to undercut you, if you have a sale going on at that time. There are a lot of things, but they're looking at their supply chain and they're indicating what is happening in that supply chain. And they're clearly telling you it's bad and it's not getting better. It's actually getting worse. And we'll talk about how it's getting worse. So when you look at CPI, how can you say that it's not going to get worse when the people, the companies like Honeywell and P&G, just a few that increase prices, are looking at their supply chain and telling you prices are going up? Clearly, prices are going to go up, and at the level they're going up. Now, there's also the component where they're going to use this as an excuse to raise prices. I am there. No one's beyond that, because show me a price that has gone up because of inflation or because of transitory issues and then came down. How many times did Hershey say, "Oh, prices are really bad right now. We're going to have to raise the Hershey bar 50 cents." And then 6 months later said, "Oh, those Hershey bars are now cheaper. We're going to take back 50 cents." No, that doesn't happen. I mean, maybe it does, and I'm too simple to see it. But you could say, well, they give more sales, they give more 2-for-1s, and that's the same thing. Yeah, but the price never adjusts. And that's where you're starting to see this push as wages can't or really aren't keeping pace. Then when you just take the summary of, okay, let's look across the country increases. This is looking at every Fed district. Gauges of a growing number of manufacturers receiving higher prices. So they're already starting to see these higher prices into April. So we know that April is going up. We know that May is going to be worse than April. And then we have summer driving. We have gasoline prices going up. We have diesel prices going up. That is obviously the case. But it's not just a year over year. It's a month over month. These are going to be things that are going to continue to drive up, pushing the levels, because when you look at it, it's just going in one very strong, very specific direction. So then when we look at number of U.S. purchasing managers reporting higher input costs, holding near an almost 13-year high. So the share of manufacturers paying higher prices are at a 13-year high, and share of service providers paying higher prices is at an 8-year high. Just based on where this is going, where the trajectory is, based on the full supply chain, this is not going to just peak and fall. It's going to peak and then go sideways for a bit, which is why we continue to say that even if things start to flatline, they're not going to zero and they're not going back to normal, which again makes this what is transitory. So then when we look at pricier merchandise, so pace of U.S. goods inflation near 10-year high. And as the reopening continues, we've been in the reopening, people that say, well, we're waiting for the reopening. Well, this is it. So take it in, people. This is the reopening. But what is happening right now? Consumer price index for commodities, which is why in the first segment, we wanted to talk about commodities. That is not going down. When you look at the shortages on supply, the rising demand for different reasons, that is going to continue to go up. And now the price index for services is also pivoting, because that is where the reopening is going to show up the most. We're going to see the reopening driving up those service prices, which is again going to be a driving force behind what comes next. Now, this is just looking at something similar. PPI construction, final demand in materials and components. So the PPI materials and components for construction are shifting up, and final demand for construction. You're seeing these moves in general, and this is not just a U.S. component. This is a global problem where we continue to see PPI surprising to the upside. Now, let's go local. How concerned are you about increased costs of household expenses? 46% are very concerned. 41% are somewhat concerned. So we have 87% of America that is concerned. Now, the poll is 3,200 people, 3,300 people. I get it. Small sample size. Maybe they picked people that aren't concerned. I know anecdotally the people I speak to are concerned. The people that I hear from are concerned. And clearly there are more out there that remain concerned about where our price is going to go over the medium to longer term. So how has your recent household spending changed? Buying less because prices are higher was at 33% for $50,000 or less. Buying as much as I used to, but it costs more, is at 34%. When you look at just that, let's go to $150,000 and less. You can see that 33%, there's been a shift into either buying less because prices are higher or buying as much as I used to, but it costs more. Clearly, people are seeing their costs go up. They have been, you're continuing to see it. But what is being recognized? What is being said? How is this transitory? When is this going away? Is corn, did we miraculously figure out how to grow corn faster? So all of a sudden corn is going to go from $6.40 to $3 again? Is China going to decide that, hey, they don't want to buy anymore? These are the issues that remain in the system, and they're not going away tomorrow, next quarter, or the quarter after. And when you look at just, okay, let's take a look at margin debt, because everybody is trading on margin as we continue to see and it's funny because there's different ways to look at this. This is just one chart I think is interesting, only because every time bad news comes out, the market doesn't care. Every time good news comes out, the market cares exponentially. So it's telling me that bad news is always priced in and good news is never priced in. And this is what we continue to see, that as the Fed's balance sheet or central bank's balance sheet continue to go up, so does margin debt, because as the Fed balance sheet goes up, rates come down, which makes margin cheap. As margin is cheaper, people feel the need or feel like it's okay, or it's a better risk reward to go out there and trade on margin. And while all of this is happening, the 10-year U.S. break-even rate is at the highest level since 2013. So it's at an 8-year high as inflation continues to come through the market. And the market is telling you it is far less transitory than I think the Fed will obviously admit. And then when we look at just the 10-year broken out a little bit differently, you can see that the Treasury inflation protected securities has come down a bit. You have TIPS that are being bought by the Fed. You're seeing some of that demand go up, but we're also seeing this U.S. 10-year break-even inflation rate shifting higher, which is going to pull that generic rate higher. Again, these are the problems that remain in the system that have yet to truly be reflected. So then when we look at the real estate loans and some of the other commercial real estate loans, you can see that banks they're just not lending as much to real estate. They've started to take this out of the system because they have a lot of debt on their books. They have a lot of non-performing loans. It makes more sense, and there's a safety component where you can just borrow it from the Fed. You can maybe buy bonds and sell them to the Fed. You can do different things, and that's why when we look at their balance sheets that are flush with cash, we're just not seeing it get pushed into the system. Or there just not as many good loans left and available in this market, given where things sit on the commercial side and residential. So then when we look at the foreign purchases of U.S. Treasury bonds, this is, I think, one of the most concerning, because as the Fed tapers, or not that they're going to, but if the Fed starts to taper, who buys our additional debt? Because nobody's cutting the deficit. The deficit's only going higher, but foreigners don't want our debt, even as yields have gone up. So as yields have gone up, it has not resulted in more buying. So that either means that the yields are going to have to continue to go up to incentivize buying, or the Fed's going to have to buy more, or we have to issue less. How is that possible? So we know that Foreigners can't or don't want to buy more. We know that rates can go up, but the Fed doesn't want them to. So then the Fed has to buy more, but the Fed already said that they can't. And you're already seeing the peaks of inflation. So can you really accelerate buying? All of this is culminating in a bigger problem as we see M2 money stock explode. So the money stock, you can see the pace of growth coming all the way through as the easing continued. You had a little bit of a pullback, and then we see it just explode in big ways, which is scary, ugly in a lot of different ways. But when we look at the triple C spreads, they fell to the lowest level since 2007. And there's a mixture of why. One, you have investors that want yield, and they're willing to go down the risk curve to get that yield. You've also had companies that during COVID went bankrupt or got PPP loans or did something to reorg or to reduce their debt load that now makes them a little bit better, and you're willing to give them a lower rate because it's not the same company that it was, even though it hasn't been re-rated higher. So there's a mixture within that. But regardless, there is going to continue to be a shift towards riskier and riskier assets to get some form of yield at this point. And then when we look at the U.S. high yield bonds are being issued faster, well, if people want it, give it to them. So now we're seeing more and more companies push into this market and try to take advantage of that demand for the additional higher yielding bonds. Now, just to wrap it up, the Treasury and agency securities, all commercial bank and bank credits. So over 26% of U.S. bank credit is to the federal government and government state enterprises. So we're seeing less go to companies, we're seeing less go to real estate, and we're seeing more go to the federal government in terms of their Fed programs. Again, the health of the underlying economy, or at least without the liquidity, is going to be very, very interesting because we have been trained or been under the illusion or been given free money since 2008 with only an increasing amount as the law of diminishing returns has increased. And the unwind is set to be very, very fascinating to see how quickly or what are the impacts. Are there impacts, or did they figure it out? I mean, maybe they did, but I don't think so. And I think that we're going to learn sooner rather than later what an unwind really looks like. So now that we've gone through that, in the next segment, we want to go into more depth on that inflation piece on company pricing and company delays as those new data sets have come out.